I think one of the key points here that the guys were kind of arguing about earlier is quite how bullish this upgrade is. I mean, you've been calling for a bit of a pullback, which we've seen, so congrats on that. And you're reversing that call, albeit still thinking that there's downside in the short term ahead.
Yeah, look, I mean, we're not really reversing anything in the near term, and we still think this pullback is in process, right? So it really began back in February, March, kind of started with the high multiple stocks because the rate move, and then kind of bled into small caps and some of the low quality areas, speculative assets, and that's ongoing, Wilf. I don't think that's over. What we did not change today was we did not change our year-end price target. So if you really want to get them riled up on the lunchtime program, just tell them that the year-end target is only 3,900. So, and look, that's fair for them to challenge me on that, given that we're in a bull market. I agree with that. The earnings picture has been spectacular. But the one thing that we're struggling with is valuation. We just don't think that the multiple of 21.5, 22 times is right, given that we now know that rates are going to move higher probably over time. That seems to be consensus. The Fed's next move will be some form of tightening, whether it's a tapering or a rate hike, we don't know. But the next move is a tightening. And this third issue that we've really been talking about pretty much by ourselves, I don't know people who are focused on it as much as we are, maybe that's wrong, but we're very focused on margins now because, look, the inflation that people are now talking about, we think is going to be a cost issue first, right? A lot of companies won't be able to pass it on, that the earnings revisions have basically peaked out at this point. And so that's another reason why the multiples can come down. Once again, it's a bull market. There's always something to buy and own, and we've navigated that part of it quite well so far this year, knock on wood, which, really focused on those reflation trades, kind of staying away from the high multiple stocks and navigating this, kind of transition period.
So Mike, the target, as we just put on screen, 4,225 for 12 months from now, essentially a percent or so from a percent or two from where we are. What's the potential scale of pullbacks and corrections between now and then? Is it going to continue like it's been for 2021, only ever being 4% max drawdown, or could there be a bigger gut check at some point between now and next summer?
Yeah, look, man, we've all gotten spoiled in the era of financial repression where these pullbacks seem to be shallower, and then we get a sharp one, right? So, in any given year for the last 40 years, the median drawdown is 14%. So that should be your baseline going into any year in a normal type of environment, where maybe there's not a lot of, too much liquidity. And so we do think it could be 10 to 15%. That would be normal. Secondly, though, Wilf, which I think is more relevant for today's markets, is that we do think we're going from kind of this early cycle, migration to a mid-cycle transition. And historically, whenever that happens, you get a 10 to 20%, pullback in the broader market, the S&P 500. Now, I'll give you the years of those mid-cycle transitions in the last 30 years. It's 1994, 2004, and then 2011. And you can go and see it was a flattish year for the overall index, but there was a pretty good drawdown in between. And we haven't had that yet. We've had it in some parts of the market. So the reality is that I'm actually more confident about that drawdown broadening out because we've already seen it in the more speculative parts of the market. That's your warning sign, right? And so I don't think it could really be completed until they finally get to the big index.
Shepard Smith here. Thanks for watching CNBC on YouTube.